MCO 05. This is accounting for managerial decisions, which is generally taught in Master of Commerce by IGNOU. So friends, without wasting any time, let's start, and do watch this video attentively. And these are our learning objectives in this video, like what is the need of accounting, definition of accounting, objectives of accounting, the different branches of accounting, advantages and limitations of the different branches of accounting, stages in accounting process, accounting concepts, and GAAP, generally accepted accounting principles. So all these concepts we'll be covering in this video. Kindly watch the video attentively till the end to have a complete understanding of this chapter. Okay, so first of all, we'll begin with the meaning of accounting. Now, this particular definition is given by American Institute of Accounting. The definition says, accounting is an art of recording, classifying, summarizing in a significant manner in terms of money, transactions, and events which are a part of at least financial character, and interpreting the results thereof. Now, the words which I have underlined, these are all the functions, the important functions of accounting, like recording, classifying, summarizing, financial events, money transaction events, they are financial transactions. The transaction should be financial in nature, or they should involve only monetary benefits, and interpreting the results thereof. That means to interpret, to analyze, to sum up the results from this accounting. Okay, so later on in this video, we'll be studying about all the definitions of this accounting. So you'll have a clear understanding by the time. Then comes, what are the different objectives of accounting? Now, basically, there are 4 different objectives of accounting. The first one is systematic recording. That means recording a transaction. Transaction means, any exchange of goods and services. Any exchange of goods and services for money is called transaction. So whenever a transaction occurs, that has to be recorded date-wise, right? So that is, in simple words, we say that journalizing, because we record these transactions in journal book. So the first important object of accounting is to record the transaction systematically, date-wise, chronologically. Then comes the second objectives, to find profit or loss, whether the business has incurred profit or loss for the year. This is very important as far as the owners are concerned, because they have invested so much of money in the business and they would like to earn profit or loss, bad luck. Then financial position. As we know, financial position is like, when we think about financial position, always think about assets and liabilities. So with the help of assets and liabilities, we can get the financial position of the company, and these things are prepared in a separate statement called balance sheet, right? So when we prepare balance sheet in final accounts. So we prepare this to know the financial position of the company. Whereas to get profit and loss of the company, we prepare trading and profit and loss account, trading account, and profit and loss account, which also we have studied in the junior classes, class 11 and 12, right? Then the last objective of accounting is communication of information. That means passing on the information, to provide information to whom? To the interested users, okay, or interested parties also you can say, interested users. Okay, so who are the interested users? These users can be, owners or shareholders, those who have invested money in the business. They can be employees, those who are working in the company. Then it can be government, because the government also like to know what is the financial position of the company, so that it can impose on the taxes, it can collect taxes from the company. Then comes customers. So they are also, interested users or parties. Even, creditors. Creditors, they would like to know whether the company is going in a profit or loss, because they have to collect their dues from the company. So that's why they are the interested users. Then we have, say, public, the society. So it also like to know like what is the position of the company, how the company is performing, okay, and how it is taking care of the society, whether it is polluting the environment or not, or whether it is providing any such benefits to the society in which it has been established. So like that. So you can write, a lot of points in this, a lot of things in these points, right? So these are the objectives. Okay friends, the next concept here is the different branches of accounting. Now mainly there are three branches of accounting: financial accounting, cost accounting and management accounting. Now let's try to understand the meaning of these three types of accounting. The first one, as the name implies, financial accounting. That means it is related with the financial matter of a company. That means two things are important here. First thing is to find the profit or loss of a company, and the second one is to find the financial position of a company. So basically, financial accounting is an art of recording, classifying, summarizing and interpreting the results which can get us the profit and loss and financial position of a company, right? In the same way, when we talk about cost accounting, as we know, as the name implies, cost. So here we are finding the cost of production or cost of a product of a company. If it is a manufacturing company, it prepares cost accounting. So basically it deals with finding the cost of a product. And what about this management accounting? Now here also it is related with the managerial decisions. The accounting which is prepared to help the management to take decisions or to frame policies, right? To frame rules. So that is called management accounting. And let's see what are the advantages of all these three types of accounting. When we talk about financial accounting, the main advantages are, recording the business transactions. All the transactions, when they are recorded in a systematic way, so that act as a proof, yes, these transactions have occurred on these particular dates. So we can refer the transactions as and when we require. Like that, financial statements. Basically, we prepare these two types of statements here. One is trading and profit and loss account, the other is balance sheet. So with the help of these statements, we can find the financial position of the company with the help of financial accounting. Then comes comparison. We compare the previous year's data, that is profit or losses, with the present year. So that helps us to make a comparison between the different years, and accordingly, we can take decisions about the future. Then comes legal evidence. As we are recording a transaction in a systematic way, so it acts as a proof if there is any future disputes with any customer or any creditor or banker. So that acts as a legal evidence. We can produce those statements in the court of law. Then comes tax liability. Now the company has to pay tax. There are various types of taxes: sales tax, excise duty, income tax, property tax. Lot of taxes are there. So to find how much tax is to be paid to the government, so that can be only determined with the help of financial accounting. We should know like what profit we have made in this year and how much tax we have to pay. Like that, information. Lastly, information is like communicating the financial result of the company to the interested users. Just now I told you about the different types of users who are always interested in the operations of a company. Okay, let's see what are the advantages of cost accounting. Firstly, we can find the cost of production of a company, of a product. That is, when we add all the raw materials, then the fuel, power, office expenses, selling expenses, advertisement expenses. So we get the cost of production of a company, of a product. So it helps to get this very useful information. Then it helps to reduce wastages in the production process. You might have seen that lot of raw materials have been wasted. So if there is not a proper planning of how much material is required in the production process. So a lot of things will be wastage. So that will be, that will add to the loss of a company or reduce the profitability of the company. Then comes comparison. Again, like the cost of production of the current year can be compared with the cost of production of the previous years only with the help of cost accounting. So this is also a very important advantage of cost accounting. Then tenders and quotation. Whenever a company wishes to get a big tender to supply its goods, so it can do that with the help of cost accounting, because with a systematic cost accounting, the company can determine how much is the cost of production and how much should be the selling price of the product after keeping a reasonable profit of return, right? So these things you can mention, you can expand, very simple. Then comes management accounting and its advantages. The first and the most important advantage, it helps to take managerial decisions, because its main object of management accounting is to help the management to take decisions. Okay, so this is very important part. Then comes planning. Now planning is also a part of decision, because after taking the decision, the management does the planning for its future, for the next year. So how should be the plan? The blueprint is prepared according to the reports sent by management accountant. Okay, then comes strategic management. Now this is a very big concept in fact, and strategic management is knowing the strengths and weaknesses of a company, and accordingly it will plan, it will make a strategy for its future, like how to expand the market, when to launch a new product. So there are many things which are considered in strategic management. Then comes analyzing the problems. What are the problems, the existing problems of a company, and it tries to find out the solution, the probable solution, the hypothesis of the problem. So with the help of management accounting, we can analyze the problem properly so that we can find a solution of that problem. Okay friends, the next concept in this chapter is, first of all, let's see what are the limitations of accounting. All the three types of accounting have certain limitations, disadvantages, demerits. So if you get a question, you can write 3 to 4 lines of these points. The first one is historical in nature. All the accounting information which we record, they are historical in nature. That means they are past events. It does not record the current prices of the commodities, goods and like that. It only, in accounting, we record all the cost at their historical value. For example, when we bought a machine 3 years back, so we generally record the cost of the machine which was there 3 years back. So it is historical cost. And the cost changes after every month. In fact, every day the cost of the materials, they change. So that is one very big mistake in accounting that we do. The second one is it records only the quantity. That means only quantitative aspect of the accounts are recorded, and there is no room for quality. Quality means honesty of the employees, loyalty of the employees, the attractiveness of the product. So all these things are absent in accounting. There is no room for this. Okay, so it only records quantity, that is quantitative aspect of the transaction, and not the quality or qualitative aspect of the transaction. It is not reliable. It is not reliable because it is not accurate. The data, the information are not accurate. There are some information in the accounting which we expect. Like for example, when we make a provision for depreciation or provision for bad debt, so they are not accurate calculations. They are just anticipation. So we cannot say this as a very scientific. Okay, so accounting suffers from this drawback, that it is not reliable, and based on this we cannot take strategic decisions. The next problem is personal errors. Whenever the accountant records a transaction, there may be some mistakes from his part. He may write 200 as 2000 or 200 as 20. So that mistakes, that cost a lot to the company. So again, we can say that there are chances of personal bias. So accounting, or based on the information provided by the accounting, the management cannot take very proper decisions, big decisions, right? Then Fifthly, expensive. So we have to employ professional people, maybe chartered accountants or financial analysts whose salaries are very high. So, the company has to spend a lot of money on this accounting process, right? So that will add up to the cost of the product, and ultimately the consumer have to pay a higher price for the product. So these are all the limitations. Now see the stages in the accounting process. So like how we will what are the steps that we follow in the accounting process? The first one is identifying a financial transaction. First of all, we will identify whether this transaction is financial or non-financial. Financial transactions, they are measured in terms of money, whereas non-financial, we cannot measure that in terms of money. So it is very important that, because in accounting, we generally assume that only financial transactions are recorded and there is no room for non-financial transactions. Then comes recording. We will record the transaction in journal, ledger, there are different subsidiary books, and then we prepare the final accounts. So the next step is to record these transactions chronologically, date wise. Okay, so like we can refer the information as and when we require. Then comes classifying. We will group the data, like for example, all the cash transactions, they are grouped in one place. All the purchase transactions, they are classified in one place. So like that, it is very important to classify the financial transactions so that we can record them accordingly. Then comes interpreting. We assess, we interpret the net results of the figure. What is the debit balance? What is the credit balance? How is the position? So that is called interpretation. Then comes communicating. Whatever the results that you get after interpretation of the result, you will pass on that information to the interested users, to the management and to others, right? So this is very important one, the different stages of accounting process. Okay friends, the next question is a very important question. It has come quite a lot of times in the previous year's examination. So you should learn this question properly. Roles of a management accountant. As we know, the role of a common accountant, financial accountant, which disperses cash and receive cash. But here the role is little bit different, higher role. Okay. So let's see the different roles of a management accountant. First of all, he does all the planning regarding financial matters and investment. So how to get finance and how to spend finance. So these are the basic two planning done by the management accountant. The second one is controlling. It will control. What it will control? It will control finance. It will control cost. So it will control wastage. So like that, you can define all these points. Controlling. He should not waste any such finance in unnecessary activities. Then he should always try to minimize the cost of production and all the other miscellaneous cost. And he also tries to minimize the wastages. So like this. The third one is interpreting. To finding the net results of the company, whether the company is in profits or losses. If in losses, what can they do to make it a profitable enterprise. So like that. So it's a very difficult job, interpretation. Interpretation is just finding the net result of the company, and based on that we do the evaluation, which is the next function of a management accountant. He evaluates. He tries to compare the previous result with the present result. And he also tries to find the authentic information and data, like how much reliable the the information are. So that is also evaluation. He also evaluates the performance of the other employees which are working under him. So there are a lot of functions, lot of things you can write in this. Then comes reporting. He will report to his senior boss. So whatever he thinks, whatever he plans, so he will always propose that to the senior manager, so that after getting the plan passed by the top management, like he can execute those plans. So like this. Then comes tax liability. He will assess how much tax the company has to pay, and basically he can be assisted in this case by financial accountant. Then comes strategic decision, the most important decisions, how to operate the activities, how to make the how to face the challenges, how to overcome the weakness of the companies, identifying the problems, and then finding the solutions. So make a strategy of that. So basically, strategy and planning, both are quite related terms, but strategic is it's a planning is for long term, and strategy are generally for a short period. Okay, so it is very important that you should take strategic decisions so that you can take big decisions, or that will help to take big decisions. Okay friends, let's move on to the next concept, and this is accounting concepts. Now let's try to understand what are these accounting concepts. Now basically, there are certain principles of accounting which are followed all over the world. That means universal application. All the accountants, those who are working in the organizations, they follow the same system all throughout the world. So that is called accounting concept, right? So there is uniformity in the accounting process. So like now these accounting concepts can be of two types. One is accounting concepts at the time of recording the transaction, and the accounting concept at the time of reporting the results. Okay, so there are two stages. Now in the recording stages, let's see, this question is very important, so try to understand nicely. So the first, at the recording stage, the first one is business entity concept. The accountant must assume that the entity, that means that business organization is an entity. The owners are different, and the business is different. Both have different identity. A company has its own seal. It can take part, it can buy assets in its own name, right? So all the contracts are between the company and the outsiders. So like that, it's an entity, it's an organization, it's an enterprise. Like that, the second one is money measurement concept. All the financial transactions, they are measured in terms of money. There is no place for non-financial transactions in accounting. So it is very important for an accountant to determine or to identify a financial transaction, right? So this is called money measurement, and all the transactions, they are all calculated in terms of money. They should have a value, and that value should be measured in terms of money. So that is called money measurement concept. The third one is historical record. That means the accountant will record the transaction as and when it occurred. Okay, like for example, the company has bought a machinery at a past date. So the date on which that machine has been purchased and its cost should be recorded on that particular date. So it is always about the historical cost. Now this is also one of the limitation of the accounting, that historical cost. So you can expand these points. The next one is cost concept. That means whatever the transactions, their values, they are all recorded at cost and not cost plus profit. Okay, wherever they occurred, the transaction takes place, so they are all recorded at the cost value. So nothing more is added into that, right? And lastly, dual concept. That means every transaction has two effects. One is debit, the other is credit. So that is called dual effect, or double entry bookkeeping. You might have heard about that. So this is dual concept. For every debit, there is an equal and opposite credit. Okay, let's see the stages in case of reporting stage. The first one is going concern concept. That means the business entity, the business enterprise will last for a long time. It will not wind up in near future. It will go on forever. It will exist infinitely. So this is one assumption, that every company has a long life. Then comes accounting period. Now we prepare account for a particular period, generally for 1 month, 1 year, 12 months. And there can be two types of year. One is accounting year, the other is calendar year. And in case of accounting year, we take it as 1st April to 31st March the next year. So this is accounting year. And calendar year, we know that is from 1st January to 31st December. So there are two types of accounting period. Now it depends on the company, like for which accounting period it will prepare the financial statements. Then comes matching. Now this is little bit tactical. Matching concept, that means in very simple words you can say that debit and credit should match. There should not be any difference between the total of debits and total of credits. So that is called matching concept. In other words, we can also say that all the revenues should be equal to all the expenses. Okay, so they should always match, and if there are any differences, we provide we provide for that, we make a provision for that, we make a suspense account, so like that. So that is called matching concept. The other is conservatism concept. Now that is, the company, the accountant, he always assumes that the company will not earn, there is very less chances that the company will earn profit, but he will provide for the expenses. He will always provide for the probable losses, but not for the profit. Okay, this much profit we are going to earn this year. So you cannot, you just can't anticipate profit in case of accounting. So according to this principle, we will definitely provide for the expenses, losses. So this is very, very important one, conservatism concept. The next one is consistency concept. Consistency, as the name implies, the methods of accounting which are employed by the company, they should not change. They should remain constant. They should be consistent. They should not, the methods of accounting should not change every now and then or every month. Okay, so that is very important. And lastly, full disclosure. Full disclosure of the financial results, the profits and losses. If the company is a big company, it has to publish its financial results in the newspapers, in the journals, because they employ public money, and the public has every right to know the financial position of the company. So this is on full disclosure. There should not be any cheating or any sort of corrupt practices in the company, and therefore it has to disclose its books of accounts. Friends, we are in the last moment of this video, and this is on accounting standards or GAAP. Now GAAP is generally accepted accounting principles, and there are certain principles which are devised by American Association of Accounting, which these principles are to be followed by all the accountants all over the world, right? So these are such very important ones. So these are called accounting standards. That means all over the world, the accountants follow the same standards of accounting. Let's see what are the main objectives of these accounting standards. The first one, it helps the users to take decisions, especially the owners and the investors. So they can take major decisions based on the accounting standards. Then comes the second objective is to ensure that there is transparency, consistency and reliability in the accounting information. Whatever the information that is provided by the accountants, that should be reliable, authentic, correct, so that management can take decisions based on them. Then to provide more useful accounting information, which are more useful to the management, which are more useful to the company. So every accountant should try to collect more reliable and more important information. Then comes to improve presentation and reporting. So the accountant, the management accountant, whenever he will report, he should report in a systematic way, properly. He should present his results, his assessment correctly. Whatever the net results that he has calculated, that should be presented to the management in a systematic, in a proper way. So the presentation and reporting, they are very important. For example, in your examination, if you are unable to present your answers properly, the examiner is not going to give you marks. So your presentation should be very neat, clean and clear. Then comes the importance. What are the importance of these accounting standards? The first one, we follow a uniform system all over the world. That means uniformity or universality of the system all over the accountant. Like here in India, we prepare profit and loss and balance sheet. If you go to America, you go to France, you go to Italy, you will find the same type of financial statements prepared by the accountants. So these accounting standards help to achieve a uniformity in the accounting process. Then comes risk and return assessment. The investors, they can assess the risk and return trade-off. How much risk is there in the investment and how much return that they should get. So in fact, both the terms are very important for commerce students, because more the risk, more will be the return. That's the principle. So it is, every investor, they always search for these two words, risk and return. Then comes auditing. As you know, the chartered accountants, they perform auditing at the end of the year to find out whether there is any mistakes in the financial statements. So it makes the auditing work more clearer and more simpler. So this accounting standard should be followed by all the accountants. Then comes government frames economic policies based on these accounting standards or the information provided by the companies, right? So this is also very important one. Then a business entity can make a comparison of the present result with the previous results. So, and if there are any big differences between the previous and the current, so, they can be minimized, or even the company can try to achieve more and more, growth and development. Then development of international trade. So this is one of the very important object of the International Association of Accounting, that international trade, foreign trade should expand. They should achieve globalization, and for all this purpose, WTO, World Trade Organization, World Bank, United Nations, so we are working very hard for this, right? So ultimately, accounting standards also aim for the development of international trade. So friends, that's all in this video, and this is like I have covered all the important topics of Unit 1 Accounting and Overview. I hope you have understood the concept, and now it's your turn to put that into the paper. Thank you very much for watching. See you in the next video.